So good afternoon, everybody. Welcome. For those of you who don't know me, and I think there are a few, my name is Trish Mosser. I am the director of Columbia SEPA's MPA and Economic Policy Management, or PEPM as we call it. I also direct the school's initiative on central banking, and I'm very pleased to be the moderator this afternoon. Um, we're happy to have you here. I'll give a little bit of background. Today's webinar is the final session of what is an annual 2-day seminar on central bank policy making at Columbia SEPA's PEPM program. The seminar is done by the Center on Central Banking Studies from the Bank of England. And it dates back actually to 2007. Believe it or not, we thought of doing this before the global financial crisis. Hats off to Professor Guillermo Calvo for that good idea. And I particularly want to thank Andrew Blake and his colleagues from the Bank of England for the wonderful collaboration that we've had over the years. The topic today is the exit from the pandemic, complications, policy needs, gaps, risks, and consistent with what is our overarching theme in the program on economic policy management. Today's discussion is going to particularly focus on emerging and developing economies, and particularly the contrast between those economies and their policy options and the options that are available to those in the advanced economy world. We have 4 great speakers and lots to cover, so I'm going to give very, very quick introductions. Starting off for about 15 to 20 minutes of opening remarks, we're very pleased that Carmen Reinhart, Vice President and Chief Economist of the World Bank, has joined us. As I'm sure many of you know, she also holds a chair at the Harvard Kennedy School and is certainly one of the world's experts on financial and economic crises. After that, we are going to have short remarks and comments from 3 additional panelists. First, Glenn Hoggarth, who is a senior advisor at the Bank of England and is responsible for leading the Bank of England's programs involving technical cooperation and assistance to the central banks in emerging and developing countries. Next will be Gian Milesi-Ferretti, who's a senior fellow at Brookings Hutchins Center on Fiscal and Monetary Policy. Previously, he was the deputy director in the research department at the IMF, where he led that department's work on the IMF's multilateral surveillance, everything from the World Economic Report to the G20, economic modeling, and so forth. Last and absolutely certainly not least is our own Augusto de la Torre. He is currently a professor in SEPA's PEPM program. He teaches financial development, an incredibly popular course actually of financial development. He's the former governor of the Central Bank of Ecuador and former Latin American chief economist at the World Bank. We will leave time for questions, so please send any questions that you have in through the Q&A button at the bottom of your screen, and we'll try to sort through those and get through as many of them as we possibly can. And without further ado, I'm happy to turn it over to Carmen Reinhart. Carmen, please.
Thank you. Well, it's great to participate in this program and great to be here among old friends. So let me just give a thumbnail sketch of what I'm going to be talking about. I'm going to, without going overboard, I hope, put the current COVID crisis and where we are in a little bit of a historic context to the extent relevant. Talk about then the recovery prospects, and especially as the contrast between the advanced and emerging market economies, as Patricia mentioned, and talk about some of the risks and challenges. Those 3 blocks very selectively are sort of the sequence of my remarks. So let me start a little bit on the historic context. You know, here we are in 2021, and a little over a decade ago, we had a very different kind of crisis. The global financial crisis of 2008, 2009 was called global, but it was really an advanced economy crisis. It was about a dozen advanced economies, mostly, US, Europe, that had systemic banking crises. And among the emerging market and developing countries, which were shaken by the turmoil in late 2008 and early 2009, the emerging markets and developing countries most seriously connected and impacted by this crisis were in Eastern Europe, primarily, with the close proximity to a lot of the issues that, especially periphery Europe, but emerging markets on the whole, again, lots of variety, and developing countries came bolted right out of the 2008-2009 crisis. That recovery was helped significantly by double-digit growth in China, which kept commodity prices very strong, and helped by the decline in interest rates that was engineered in the advanced economies as monetary policy accommodated across the major central banks, and helped also beyond the commodity price channel, beyond the trade and growth channel, and the decline in interest rates. It was also helped by a big surge in new financing from China, especially to a lot of the lower income commodity producers. So the COVID crisis is very different from the last big crisis to hit the global economy. COVID started already with countries emerging market countries in much weaker shape than they had been in a number of years. After the big decline in commodity prices around 2015, growth had slowed, debt had been built up, both public and private, and it was very clear that the boom period of, say, 2003 to around 2013 thereabout was over. So initial conditions were already more complicated for many emerging markets as a consequence of the slower growth and the pre-existing debt buildup and fiscal deterioration. Again, I'm generalizing. There's a lot of heterogeneity here. Countries entered COVID. Many emerging markets entered COVID with a lot more limited fiscal space than more limited capacity to deal with the massive shock of 2020 in terms of historic output declines and so on. So a big concern at the moment is that the global economy, instead of moving in the direction of convergence, which it had been on and off for some time, is on a path of divergence again. Hopefully not a replay of the 1980s, but that is a concern. Emerging markets, first of all, starting this is stating the extremely obvious. This is a health crisis. It didn't start out as a financial crisis. It didn't start out as a housing bubble. In varying degrees, as I said, countries had different fragility, but because it started as a health crisis and it remains a health crisis, it's not over until vaccination processes become more complete in the emerging world, and variants of the COVID virus stop emerging, and a truly global recovery gets underway. I think if one reads the financial press, especially the US financial press, one forgets that the recovery, indeed the overheating concerns that one has seen in day to day in the press, are an emerging market luxury, and that per capita incomes in many emerging markets, in the work that I've done with Ken Rogoff on dating recoveries and how long it takes to recover, we really take a very minimorum definition of recovery, which is how many years, how long does it take you to have the same per capita level of income that you had before the crisis. So it doesn't even take into account potential, output growth. It doesn't take into account a trend line. It just asks that minimum question: how long does it take you to get back? Well, I think for many countries, the road back is going to be a multi-year process, unlike what we're seeing in advanced economies, which had much greater firepower on the fiscal side and on the monetary side than emerging markets. So my setup and prospects is more or less, I think, laid out the stage to talk about, in this bifurcated recovery that we're seeing, what are some of the risks. Let me also add that the bifurcated recovery has also been reflected in many dimensions, and one important one for most emerging markets has been their assessment of country risk. After the 2008-2009 crisis, what you typically saw were downgrades, credit rating downgrades of advanced sovereigns, while many emerging markets and frontier economies were upgraded. Now what we're seeing is disproportionately large level, more than 40% of the sovereigns, emerging market developing country sovereigns that are rated have been downgraded. The share for advanced economies is about a third of that, even less. For those countries that are too poor, don't have access to capital markets, that aren't even rated, the World Bank has a 4-tier grouping that says whether the countries have a low risk of debt distress, a moderate risk of debt distress, a high risk of debt distress, or are in debt distress. More than half of the 73 low-income countries that are eligible for the DSSI, the Debt Suspension Service Initiative, are already either in debt distress or at high risk of debt distress, and likely to make the jump very soon. So a big question mark, a big source of risk is on the debt front. Another sovereign debt front, another big source of risk, and I'm focusing on the risks, okay? And it's no question that one can talk about opportunities as well, given the shock. Another is that as this crisis continues to linger longer in many, if not most, resurfacing several times of the emerging and developing countries, it isn't just sovereign balance sheets that are getting impacted, but households and firms, and therefore banks. So a lot of, during the pandemic, certainly it's, for many of the advanced economies, notably the US, stimulus has hit both fiscal and monetary, either hit historic highs or certainly historic peacetime highs. For many emerging markets, let me say that this is a central banking seminar. The central bank response to COVID was unprecedented in terms of, almost across the board, emerging markets being able to, for a change, act counter-cyclically to the shock. It is not unusual that faced with adverse shocks and often loss of confidence, the reaction of central banks in many emerging markets ends up being pro-cyclical, tightening to stabilize expectations, to stabilize the exchange rate, and tightening into bad times. This time it was actually counter-cyclical. Now, that of course needs to be acknowledged, but let me add that another important, besides some fiscal stimulus, not in the remotely the orders of magnitude of what we've seen in the advanced economies, but despite some fiscal stimulus, despite some monetary, substantive monetary stimulus, another form of stimulus, liquidity support, in emerging markets has been forbearance programs. Banks and many financial institutions have either voluntarily or not so voluntarily, had to heed policies where to provide households and firms with forbearance, i.e. not, temporary reprieve from repayment of debt to help them weather the storm of temporary or not so temporary job losses and reduction in business activity. At the moment, and I'm still talking about risks, okay? I rambled on for a little bit, but I'm setting the stage for I mentioned the sovereign risk. Well, another risk is that as those measures have been phased out and continue to be phased out, more will be known as to, on the firms and households, how many of those loans will be not illiquid, but insolvent. So I think there are causes for concern on the financial fragility dimension as well. This did not start as a financial crisis, but its severity can certainly help it morph into one. And even in those cases where you say, no, this is the initial conditions where banks were strong, this is not a systemic banking crisis, it may not even be a borderline crisis, one can still be concerned that uncertainty about the economic outlook and uncertainty about the actual health of their current balance sheet makes banking institutions, financial institutions more conservative, and you can still have a credit crunch, which would be a headwind to recover. So that's another dimension of the risk. I could go on, okay, because COVID, the impact of, building takes time. Destruction can be very swift. And nowhere has that been more evident also than in the dimension of poverty. Poverty had been inching, poverty rates globally. This is from the Poverty and Shared Prosperity report we published last year at the bank. It's been inching down, steadily for decades. Last year was the first spike in global poverty rate since 1998. So, the risk that macro tools are not there to deal with poverty and inequality issues. That central banks also may be unable to sustain the stimulus they provided because of inflation concerns. Don't forget, inflation is also quite regressive, especially in emerging markets where so much of the inflation comes through food prices. So the combination of more frail sovereign balance sheet, more frail private balance sheets, and constrained fiscal space in the form of deteriorating economic and poverty conditions. It's not. I know this sounds extremely negative, but I mentioned that I would talk about risk. It also raises, it's a ripe environment for social unrest, which has often accompanied these very turbulent periods. And, I hope in the discussion we get to talk about how to avoid this becoming a replay of the long-winded aftermath of debt overhangs in the 1980s. So let me stop there.
Thank you very much, Carmen. That was great. You sort of literally covered the territory, all of it, as far as I can tell. I think one of our panelists is having a little trouble joining. So I'm going to, if he doesn't mind, ask Gian Maria if he would go next. Hopefully Glenn will be able to join us in just a minute or two to give his remarks. Gian Maria, please.
Hello, everybody. I hope you can hear me well. Can you hear me? Yes, good. So let me just take 30 seconds to say how happy I am to be here with old friends. Guillermo and I were together in Poland basically 30 years ago to the day in a village in northeastern Poland, teaching economics to professors and graduate students from Eastern Europe. The world has changed a lot since. And Carmen was really my mentor when I joined the fund. I didn't know any econometrics, and she very kindly taught me some before I engaged in my first IMF mission. And Augusto, I know from many years of across the street collaboration fund bank when I was in the Western Hemisphere department at the IMF. Oh, it's a real pleasure to be here and an honor to be here with them in this panel. I have left the fund a few months ago. My finger on the pulse of the global conjuncture is slightly less firmly put than it used to be a few months ago. Let me offer just some general remarks. I will start by saying I completely agree with the points raised by Carmen, and I think she really emphasized the ample range of potential risks, and she correctly stressed that there is, when we talk about emerging world, we tend to do so a bit aggregating countries, but there is really a lot of heterogeneity in what we see, and also in terms of the incidence of this horrible crisis. So one of the remarks I wanted to make is to highlight one corner of the emerging world, which is not really on the poorer side of it, but which has been unbelievably heavily hit by the crisis. And that is the countries that rely on international travel, on international tourism. And the numbers here are absolutely staggering. I'm writing a piece on this, and you have a decline in tourist arrivals of something like in the range of 80%. Globally for 2020, tourism revenues, international tourism revenues down, 2/3, and that's just because the first 2 months of the year were still okay. For a number of countries on the smaller side, this hit is enormous. These are countries that get literally 30–40% of GDP worth of revenues from international travel. And those revenues basically have fallen dramatically. In addition to that, a lot of these tourism-dependent economies, even though they're not very poor, they're very indebted to start with. And hence, it's a hit that is very severe. And it's not just really limited to the emerging world. We have a number of advanced economies, think of my own, of Italy, but more heavily still countries like Spain, like Portugal, like Greece, that have been hit very, very heavily. And the pace of reopening here may also look quite different. Things are probably a little bit better for the more advanced European countries where you have more widespread vaccinations, where mobility is restarting. But it is a different matter for the emerging world. And again, this probably will not register on a scale of, a global macro to the same extent that, say, a dramatic downturn in India or China, given that we're talking about mostly smaller countries. But it is still a number of countries in potential or actual distress right now. And indeed, and this goes a bit to, the issue of spillovers, who's affected from the COVID crisis. We've looked at how the growth in emerging economies has been affected in 2020 compared to forecasts. And the single most powerful predictor is the relative importance of tourism in GDP. It is much more significant, much more important quantitatively, even than the severity of the domestic pandemic. So this is clearly spillover. Some of these countries may have been, getting few cases, but they don't get revenues anymore. So this sort of consideration looms large in thinking about how a recovery will take place. That is, how will the shape of the global economy be a few months and then years down the road? What rebalancing in terms of sectoral activities will take place? We all hope that we can go back to the growing demand there was for contact intensive services, but we are clearly not there yet. And the lull may prove very difficult to sustain for countries that start from a highly indebted position. A second point I wanted to make is and again, is a point that Carmen has stressed, and I think is absolutely crucial too, and it is the incredible degree of uncertainty that we face. And we can see it in not just, we are normally not very good forecasters as economists in normal times. And in this world, we have to think about the consequences of a pandemic, which has really no historical comparison. I mean, we go back to 1918, but it was a different world. And it's not just the uncertainty on the path of the pandemic. And again, we all hope that the race between vaccine and variants will continue to be led and won by vaccines. But the uncertainty is not just about the evolution of the pandemic, but also how that will interact with economic activity. We, on the positive side, we've been Had we known a year ago the extent of second, third waves of infections, we would have been dramatically more pessimistic on the world outlook, dramatically more pessimistic. We had scenarios with second waves that looked absolutely awful. Second waves and third waves have materialized, but somehow the economy has been able to deal better with these circumstances, still with tragic outcomes in terms of lives lost, but more nimble adaptation of economic activity to this, particularly in the manufacturing sector, but not exclusively there. We're going to have to see how that will continue, going forward. And we've clearly also been very positively surprised by the degree of market optimism. Again, if we dial back 14, 15 months to March, 16 months to March of 2020, when were real concerns of a tailspin in markets as the severity of the crisis was becoming more evident. This is again a very different world. Clearly, policymakers have learned a lesson, at least in most advanced economies, maybe not everywhere, but in most countries, about the need to be aggressive and have unprecedented responses to unprecedented challenges. And that has clearly helped. But again, it's very difficult to count on a continuation of optimism in a situation where, again, the degree of uncertainty about literally the shape of the world economy in terms of sectoral composition, in terms of relative demand for goods a few years down the road is still so uncertain. I think the international community will have to take steps to design appropriate strategies to deal with the likelihood of a wave of needed debt restructurings and write-downs. It is a process that is taking place that is going to be very messy, I'm afraid, just because the composition of creditors has changed, and coordinating write-downs has become more easier in certain respects, but more difficult in others. And unfortunately, the rise in geopolitical tensions between China and the West, broadly defined, is not a good omen for agreement on these fronts, because China is taking a bigger and bigger role, as again Carmen has indirectly alluded to and directly alluded to with her work. So I think again the challenges that Carmen has identified are going to be at the center of our attention, or the attention of international organizations, of policymakers over the next few years, for sure. And again, there are clearly regions that are going to be more heavily affected than others. I leave it for now at this. Thank you very much, and very happy to come back in the Q&A.
Thank you so much, Gian Maria. Wonderful. Glenn Hoggarth is from the Bank of England is joining us. Glenn, very nice to see you.
And you.
We're happy to have you. But I'm going to turn it over to you now. You may have a few slides, but perhaps the folks here at SEPA can share those for you.
Yes. Okay. Thank you very much. I don't need to show the slides quite yet. What I would like to talk about, hopefully building on what's been said, although I'm sorry I missed the first Carmen's keynote introduction, is some issues facing central banks in developing countries, but specifically in sub-Saharan Africa. I've been doing some work looking at some of the risks they face. As one can imagine, perhaps the challenges they face are so much more acute than for most other areas of the world. Not just to start with, is perhaps becoming a big risk now, although it wasn't a risk 12 months ago, or even 9 months ago, I would say, is the COVID risk. I remember at the start of the outbreak, there's certainly fears, big fears that Africa would be hurt tremendously by COVID. And it didn't seem to materialize, at least for the first part of the COVID crisis. That's changing now, though, unfortunately, quite sharply over the last 2 months, where cases and deaths have been increasing, especially in Southern Africa. And on top of that, as we know, the rollout of vaccines has been so much less there than most other regions. So, for example, the number of doses at the moment that have been given is only represents about 1 to 25 to each 25 people. So it's a long way to go, a long way behind most advanced countries and other emerging markets. And if that stays like it is, which we hope it doesn't, then that's going to loom large over the coming 12 months. But let me turn to these more direct economic risks for central banks, one of which I imagine Carmen must have focused on was the massive debt overhang, which with the debt for developing countries has doubled as a percent of GDP even before COVID-19 started. And that really held back the amount to which fiscal space developing countries could use to try to spend their way out of the crisis, or at least ease the constraints. So whereas high-income countries spent on average 10% of GDP, which is massive by any reckoning, developing countries only spent 1.5% of GDP in terms of fiscal loosening. So the heavy work was done more by the central banks, relatively, in developing countries. And to some extent, they mimicked the high-income countries. They used conventional policy more because they had more space to cut rates, but they also used unconventional monetary policy. And they also, again, like in high-income countries, eased various prudential standards for banks, or aimed at banks. And if you're looking ahead, if one wanted to take a positive view, perhaps, then one could say, well, there's still monetary policy space left. Interest rates can be cut further in developing countries, including in Africa. Interest rates are way above zero. And the latest IMF forecast, at least in April, for the median inflation rate in sub-Saharan Africa was only 4%, which by historical standards is very low for the region. So perhaps one could argue there is some policy space going forward, but I think that may be an exaggeration. There are a number of really big risks. The first one is that inflation outlook might not be so benign. Commodity prices have been rising quite rapidly in recent months, over the last 6 months or so. Given the COVID overhang, there could be further exchange rate depreciations in the region, or more generally in developing countries, either because of the further COVID shocks or because of unexpected interest rates rises, say in the US. If that does happen, then there is a risk that inflation will rise. We know that the pass-through of depreciation is bigger and quicker in developing countries. So there could, and the first round effect will be hurting the poor the most, because it's the increase in imported food prices that will hurt the mass of the population in developing countries. And we've already seen inflation fears affecting some emerging markets. So we've seen rates being increased by central banks, for example, in Brazil, Turkey, and Russia over the last 6 months. So why not in sub-Saharan Africa? But related risk is central bank credibility. Most, I'm not sure it's all, but most governments around the world have partly financed their deficits and debts, especially over the last year, through borrowing from the central bank, either directly, or in the case, say, of the UK and other high-income countries, indirectly through unconventional monetary policy. But in many developing countries, it's been direct. It's been traditional, call it traditional, conventional money finance of the government deficit. And there's a risk here, certainly, that either economic or political risk, that there will be concerns that inflation is not well anchored. The expectation is not well anchored, especially where there's not a track record of keeping inflation under control, such as many emerging markets have done through inflation targeting. So I think there's a risk there, both an economic and political risk for central banks. The next risk is, I won't have too many risks. I don't want to be too negative, but there is a risk to banking systems. It's the domestic banks which have done the heavy work in financing the government deficits and debts in developing countries. The standard way that we measure risk capital ratios are exaggerated because it assumes that the risks that banks face lending to their own governments is zero risk in using the Basel formula. That can't be true in many countries where the government debt is in distress. And we do have a risk in some cases of a kind of, well, a twin crisis, a sovereign banking crisis, which we've seen many times over the past 40 or 50 years. Finally, let me touch on balance of payments risks. This will be my last risk, which is current account deficits are wide in a number of developing countries, certainly in sub-Saharan Africa. On top of this, there will be a need certainly to repay short-term debt certainly over the coming year or so. Question here is, do central banks have enough foreign currency reserves to cover the need for this financing? Could have this first slide, please? If you look at this slide in front of you, this shows the size of foreign currency reserves in relation to the so-called external financing needs of countries in the Southern African Development Community. That's the 16 countries listed. And you can see there's a mixture, but quite a few countries barely have enough reserves, 100% of their financing needs for this year. Now, let me finish there on a more positive note. I think it is the case over the last, with a change in the US administration, there's been a sea change from my perspective, looking at the G20, of the attitude towards the bigger economies, towards helping developing countries or acting more in a multilateral fashion. I think that gives some hope. And because of that, at least there's a chance that the big and richer countries will try to do more to alleviate problems in the developing world, either through helping where there's a risk of actual default or helping with longer term structural programs. But in the context of what I'm talking about, which is central bank liquidity, there is going to be a big injection of 650 billion in special drawing rights, synthetic currency of the IMF, which can be converted into euros or dollars or other hard currencies. That 650 billion, though, unfortunately, won't all go to the countries who need it. It's given out according to shareholding in the IMF. So it will go out, those direct recipients will be based on the size of their economy rather than necessarily what they need. So how does that translate to the countries in the Southern African zone? Can you put the next chart up? Slide up, please. So you can see here, it's not based on financing needs, it's based on the size of GDP. A few countries will get quite a big boost to their liquidity or in terms of the foreign currency reserves, but many will only get a small amount. If you take the so-called SADC region as a whole, Southern African region as a whole, it will only add, if you look to the right-hand side bar, it will only add 10% to their stock of foreign currency reserves, which for the region as a whole is barely enough to cover the likely financing needs. So what's needed is, and what I'm sure will be in prospect, is a way of translating some of the SDR's liquidity that's been given to the high income countries back to the low income countries. So the moment of that 650 billion that will be given out, only 1% will be going to this set of 16 countries or 15 countries if you exclude which you should do, exclude South Africa, which is clearly not a developing country. So there will be a lot of work in the next few months, I'm sure, of trying to think of different ways that this liquidity can be given to developing countries, perhaps bespoken to be used to help them finance vaccine rollout. But let me stop there. Thank you.
Thank you, Glenn. Augusto, the floor is yours.
Well, thank you very much, Trish. I'm very, very happy to be here with old friends. I haven't seen Carmen and Gian Maria for a year. It's great to see them at least in the internet. Good to meet you, Glenn. And again, congratulations to you and Guillermo for keeping up with this fantastic Bank of England event, which is a high point in our students' education. I really liked the label that Carmen uses to characterize this bifurcated asymmetric recovery. And so I want to make some comments and elaborate on some thoughts that I think go around Carmen's very, very complete characterization of the issues. I think we're still trying to ascertain how sick is the economy of the world, how bad is the illness, and whether we can have a sustainable recovery. And that's why I think most of us are still thinking of the risks. I guess we economists get paid to think about risks more than opportunities, at least the economists among us that are macroeconomists. So I will also sin on that side. I will focus a bit on risks again, and maybe during the conversation we can put the positive side on the potential upsides. So I'm going to organize my comments about two ideas. One, which is the difficulty that emerging markets, and when I say emerging markets, I tend to talk from the point of view of Latin America, which is the region I know well. The difficulty emerging markets have in ascertaining what is going to be the global context in which they are going to live over the next 2 or 3 years. And understanding where, for instance, the US economy is headed seems to me has become a very, very difficult challenge. As Carmen said, of course, the US is bolting out of COVID in a very strong way, hitting bottlenecks and therefore hitting inflation rates that we have not seen for a decade or more, even more than several decades, expecting a growth rate of around 7 to 7.5% in 2021. And therefore creating a sort of movement towards the roaring 20s. But all of us wonder how sustainable this is, because the macro financial setting in which this is happening is very problematic. As Carmen was saying, we have reasons to doubt that the US will maneuver its way into a soft landing. You know, I take it that the US has this exorbitant privilege and can buy itself maneuvering room by the fact that everybody in the world is willing to take US assets. But money printing and debt printing that the US has done in the past few years and with COVID is unprecedented, ginormous, and we do not know how much of the abuse of the exorbitant privilege would allow the US to maneuver through this. Government debt is now at 100% of GDP in the US and is expected to reach 200% of GDP in the next 20 years or so, or 30 years. M2, which was about 50% of GDP in 2007, is now 100% of GDP. Of course, behind this huge expansion in M2, you have a huge expansion in the balance sheet of the central bank, of the Fed. The Fed used to have an asset side in its balance sheet that was less than 5% of GDP, and now it's 40% of GDP. So much of the M2 expansion is the fact that the US has given people cash-like instruments and has taken risky assets. And this is still a pending issue. How will this be unwound? And then you have the problem of similar expansions in corporate debt that has gone through the roof, but because interest rates have been so low, debt service has not gone through the roof. So you have this asymmetry of very fast rising debts, very slow rising debt services, but therefore a great sensitivity in the system to interest rate increases. Now, we have this accumulation of savings, some of it structural, because I think we're still living with a savings glut in the world. Some of it COVID related, as people were forced to postpone consumption, postpone investments, and that has created this pent-up demand. How will that go into the market for goods and services and pressure prices upwards? And how would that go into the market for assets is still very unknown. But one thing is very clear to me, that US Fed is trapped in a sort of a prisoner's dilemma. On the one hand, it would welcome some inflation, including to dilute the debt. But if that expectations of inflation get unhinged, we will have a very different trajectory in financial markets. On the other hand, raising interest rates has become a major problem for the Fed. Not only because it's politically difficult, but mainly because given the excess saving that we have in the world, we have kind of a bias towards a low level of economic activity, which makes the Fed more willing to keep the interest rates low to prop up demand. But also, there's this sort of financial dominance now in the US, in that if the Fed raises the interest rate too much, it may create a lot of instability in financial systems, where moral hazard has gone up enormously, because everybody knows that the Fed allows a put option without limits. So I think the financial markets in the US have gotten used that they can play with risky assets, and when they get spooked, there's a buyer of risky assets. That's a willing buyer, or a willing buyer of risky assets. So that allows much more frothing and instability in financial markets. So when we look at this from Latin America, we really do not know whether we were going to be living in an environment of inflation or in an environment of financial instability. And we're all betting that somehow the Fed will maneuver into a soft landing, but it seems to me that the space to do that well is narrowing in a very significant way. So that's the issue about what world in which emerging markets are going to be living. Then I want to mention 2 or 3 issues about the recovery in emerging markets. First of all, as Carmen was saying, it's coming with a lag. And unlike the 2009, 2010 recovery, where balance sheets were strong, government balance sheets were strong, households balance sheets were okay, corporate balance sheets were okay, China was able to pull the recovery in emerging markets in 2010, and the emerging market world recovered much faster than the advanced economies. Now the lags are going to be significant, including because of the delays in vaccination. So you have this big problem of lagging in the recovery. Then you have the recovery with weak balance sheets. And that's a very very different story than the recovery with strong balance sheets that we saw in 2010. And in particular, government balance sheets will require some fiscal consolidation, which seems to have become almost impossible because of social tensions. When you look throughout Latin America, you see incredible amount of social tensions, social fractures, and that rise of populism So maneuvering the recovery with fiscal consolidation is going to be an incredibly much more complicated challenge in emerging markets. Third, we do not know, I mean, we do know that the financial systems, at least in Latin America, entered COVID in good shape. So for a change, Latin America entered this crisis with strong banking systems. But we do not know how the banking systems are going to come out of this mess, because there's quite a bit of delayed recognition of NPLs and loan quality problems because of the forbearance that has been applied urbi et orbi. And we do not know how exactly we're going to get out of this forbearance in an elegant way without destabilizing. And the final point I want to make is that recovery in the emerging markets cannot be only an issue of recovering or of using unused capacity and restoring domestic demand to a level that's more compatible with full employment. It's not that. I think recovery in emerging markets will require restructuring, finding a new production structure, a productive structure that's more compatible with growth, finding a new place in a global economy which we do know the shape of, whose shape we do not know. And that will require not just debt, it will require capital. So the sense I get is that the shortage in the process of recovery in emerging markets will not be so much on the debt side, but on the capital side. And that's a much more complicated nut to crack, because the World Bank and the IMF know a lot about transferring debt flows, but they have no clue as to how you transfer equity flows. And Latin America has not, at least in this history that I have studied, has not been able to use well foreign savings and attract foreign savings in the form of FDI. So I think a lot of the discussion of the recovery, given the constraints, given the balance sheets that we have, and given the shortage of capital, will have to go to center around the issue of recovery with FDI. And I do not know whether we understand that problem well in emerging markets to overcome it.
Thank you, Augusto. And thank you, all of you. That was fantastic. I don't want to tell you how many questions I have written down, but I'm actually going to be a good moderator, and I'm going to forbear for a minute, because I think we should let Professor Calvo ask the first question, and I know he has at least one, if not more.
Okay, thank you very much, especially all the panelists. This is really an honor, a pleasure for me to have friends and such high quality economists join us today. We really need quality here, and the views that have been expressed really open up a horizon of issues that are very important. Let me say first that a name that I don't want to forget is Mario Blecher. With Mario was working at the Bank of England at the time. We joined forces to create this association with the Bank of England. Now, I think given the array of issues that have been mentioned here, it's very hard to say something positive about how to go ahead. I think I have more questions, and very important questions out there. One thing, sort of question have to do with the ability of forecasting, which is very limited for us economists and anybody. But then there's still an issue of incentives. It seems to me that when you look back to experience of emerging markets since the 1990s or earlier 1980s, you see that there were some crises that it took a long time, were very painful to recover from. The debt crisis, for example, of the 1980s was mentioned by Carmen, and later the Asia-Russian crisis in 1997, 1998. Now, characteristic of those is that the emerging markets were on their own. They didn't have a lender of last resort. Global central banks did not play a big role. And that's a sharp difference with what we have seen. I agree that the present crisis is not the same as the Lehman crisis, yes, but in both, you see central banks acting very strongly and making a difference. In 2008, we know that, so there's not going to be disagreement. The question now, I think something of that sort happened, but can also because at the very beginning, when we thought that the flight to quality from the emerging market was going to be the end of emerging markets for a while, immediately, they recovered very quickly too. It's a different recovery, I agree, and that's where the problem lies. But we see that advanced economies can make a difference by the hand of a central bank for emerging markets. So central banks are at the center of this. Whether the central bank will be able to continue playing that role, that's a question that we want to address now in this part. But it seems to me that that experience teaches us. In the first place, Carmen mentioned, he said, we are facing a geopolitical problem. And I think that is at the center. How you motivate advanced economies to continue helping emerging markets. And there is one avenue that where my question is directed to. The avenue is that we have a sanitary crisis now, which is a negative externality. It's good for everybody that everybody in the world, most people in the world, get vaccinated. And to get that to happen, you need money. And also you need that the countries on the other side are prepared to take the corresponding action in order to make it effective. And so maybe there's some room there. I'm looking, this is the way I'm thinking about it. The problems are unsurmountable that were put on the table now. They're enormous. So how can we motivate those that have the exorbitant advantage to give us a hand? And I think maybe vaccination is one possibility, but I'd like to hear speakers. And once again, thank you very much for your fantastic presentation.
So do one of the panelists want to take that one on first?
Well, I mean, it's a huge question whether the advanced economies, based on the nature of the shock, i.e., that it has, as Guillermo points out, these global externalities, but also in the context of their own cyclical position, which right now, as we've been discussing, all of us, is so different, whether they're going to be there to help. I think that's a huge question. I don't know the answer, but let me offer, Guillermo, so I don't know the answer, but let me offer some thoughts. I think the kind of, and I will add to the examples that you've offered. I mean, I think a big motivation for the US bailout during the Mexican crisis was also motivated by the fact of concerns about inward migration and the impacts on the US we're very much on the same line. That's not a surprise. But a big question mark we now have, and as you point out, forecasts are uncertain. We don't know whether the inflation pickup that we're seeing is is whether this is it or this is the tip of the iceberg, whether it's temporary, if it's temporary, how persistent. And so, and the million-dollar question is, how will the Fed respond to it? You know, and Augusto mentioned this, you know, also the bias towards easing. I do think we have an asymmetry. I agree with you, Augusto, that we do have an asymmetry, that it's a lot easier to ease than it is to tighten in an environment also where you have such high degree of leverage on the government side and on the private side. But also, let's not forget, I've been talking about a Fed put for a very long time. I mean, it used to be a Greenspan put, and you know, and it morphed, but it's a Fed put. So the idea that you know, the factor that of what impact if in this scenario where inflation increases and, you know, it increases in a more persistent manner, let's not call it permanent, a more persistent manner, how quickly will the Fed react? So Guillermo, based on our own work, that would suggest that some of the risks from the cyclical response would not be, you know, what the doctor prescribes for emerging markets. And let me conclude by saying, I am actually, when it comes to debt write-downs, what I am seeing is the eternal, not 1980s, the eternal, going back to the early 19th century, reluctance of creditors to take haircuts for any reason early on. You only get to the haircut stage, you only get to the write-offs after you've tried a whole variety of things and all of them have failed. So I have concerns. This is my own opinion. This is not a prediction, but my own opinion is that we're still at that reluctant stage, and even putting forth the issue of externalities, the idea of a debt for vaccine swap, or you know, some kind of write-off connected to this is still would be a very hard sell. That's.
Thank you. Comments? Gian, Maria, Augusto, Glenn?
Yeah, hard. Guillermo alluded to geopolitical, you know, equilibria, and there may be an issue there, depending on, again, what happens to global tensions on that front, and how strongly do the creditor countries in the advanced world want to keep certain emerging markets in their camp. So there may be reasons that go, you know, Carmen correctly mentioned the spillovers, very direct ones through migration, maybe others through financial markets that are also a source of concern. There may be others in this sphere, but I'm clearly not the right person to talk about them. I guess there's a half of Brookings that does is really foreign policy and deals with this type of issues. I would just raise just one little ray of positive developments and that has to do with what is happening, is happening in this recovery with commodity prices. It is true that there is a relative price shock, and we are worried about the extent to which it gets built in. But it is also a breath of, it opens space for some of the countries that were most under pressure because it raises revenues. There has, the external side in EMs, current accounts have generally shrunk just because domestic demand has collapsed. But as domestic demand recovers, having commodity prices inch up is extremely helpful. Again, we're going to have to see where this ends, what happens to the supply chain disruptions, and how quickly can supply come back. I mean, how much is leftovers from the crisis, how much is a more structural imbalance. It will take a longer time to resolve. But I think that aspect is one that we should keep an eye on, but that could give a bit of room to EMs more sensitive to these relative prices.
So I'm sorry, Augusto, to interrupt, but I wanted to add a little bit because I have had a question. There's also a couple of questions that have been submitted about inflation and U.S. inflation, which several people, Augusto in particular, talked about the risks, which certainly I completely agree with. Persistently higher inflation is going to be, I'm going to speak as an ex-Fed person, will lead to higher U.S. interest rates, which we all know how that story plays, and it's not pretty for the United States, and it's really not pretty for the rest of the world. And it's not pretty for the U.S. in part because of its debt overhang situation at this point. But how contagious is this inflation? And it kind of gets to, it's related to what Gian Maria said. It's clear in the U.S. The U.S. is the marginal consumer for, particularly right now, for almost the whole world, because it's out in front in terms of recovery, and it's a regular significant net debtor, particularly the household sector is to the rest of the world. So the fact that it's recovering quickly in the rest of the world much more slowly, mostly, means it's not surprised that all the aggregate supply shocks that COVID created are coming home to roost, like now. But my question is, how contagious is that to everybody else? First of all, it doesn't seem to be contagious to the other advanced economies, which I find interesting, particularly. We know it's certainly contagious in commodities. I would be really interested in people's views about, we know what's going to happen if it becomes persistent, but I think the question is for emerging and developing economies, how contagious could the inflation in the United States be, even if it does go on for a while? And my personal opinion is the odds of the Fed being pretty tolerant of this could go on for quite a bit. It's a risk. It appears a risk that they're willing to take. Sorry, Augusto, I interrupted you.
Yeah, I'm still thinking of the previous question by Guillermo.
Yeah,
so I'm gonna,
no, that's fine. Please go back.
Inflation contagion
thing. Talking about inflation, I wanted to add it. That's all.
Guillermo will answer the question on inflation contagion. Well, I was just going to offer a reflection that seems to me highly paradoxical. COVID is like is a shock similar to a meteorite hitting the Earth. No, it's a disaster. It's a global disaster. So one would naturally expect that when the whole Earth is hit by a global shock, the opportunities for global cooperation, solidarity, and collective action should increase. And maybe that could open up some spaces for thinking of a reconstruction type mode of action, mini Marshall Plan type ideas, vaccine for debt relief. So one would expect that a world that has suffered so much should be willing to hold hands together. But yet it's difficult to be optimistic on that side because of the tensions between, say, the advanced economies in China and people looking after their own local conditions, and the transformations that in the global production change COVID may persistently have. I do not know, but it seems to me that people have learned that just-in-time inventory and global supply chains are very fragile. And so people may want to build more redundancy in the future, less efficiency, more redundancy, more nearshoring. So the reconstruction of the, I don't know whether COVID will unleash an important restructuring of production, the distribution of production around the world. But I think that one point that Carmen made is important. Perhaps one thing that can help collective action internationally is the fact that immigration has become such a big issue in the advanced economies. And so one reason to be good to the emerging world is to limit out migration. And maybe that can also be used to hold together some level of cooperation. I'm not very optimistic about that, but I think that that's one. And the other one that always haunts me is that, you know, I see the US dealing with these problems of asset price frothing and bottled up movements and changes in moods in capital market, a huge Fed put option that facilitates that. And so you see these funds looking for investments in the advanced economies and a lot of investment needs in the emerging markets. So I think we have a problem with the way financial systems operate. They seem to be unable to put the two sides of the market together. So you have these problems of excess savings and excess finance, so to speak, in advanced economies, and shortage of investments in emerging markets. And I wonder whether that also creates some opportunities to be more creative in places like the World Bank or the IMF to help somehow financial markets intermediate these excess funds towards more sensible investments that are much needed in emerging markets. That is, for me, a very difficult question to deal with, but seems to me a global paradox that the US is having financial frothing and the search for yield and all of these problems that the US may have. And those funds do not get channeled towards the dire needs that you have in emerging markets.
So, Patricia, if I may come in here very quickly on your
Please.
contagious inflation question, but also a point that Augusto has been raising, which is why doesn't equity flow from north to south? Which is, you know, I think, so just a couple of brief points on that. Look, on the, is inflation contagious? Well, the traditional channel of imported inflation via fixed exchange rates is not, but I would highlight that, and this goes to Glenn's presentation, for a lot of the in distress countries. Okay, let's leave aside the fact that at the moment, we already have a number of extreme inflation cases. We have Venezuela, we have Lebanon, we have Zimbabwe. Argentina is not in that, quite in that league, but it's, you know, pretty out there. And for a number of the cases that Glenn was talking about, inflation is not running, it's galloping. You know, the Angolas, the Mozambiques, you know, this is and this is a different phenomenon. It's not necessarily because any U.S. development there is contagious. Is debt difficulties don't travel alone. If you have a foreign exchange shortage, what do? You put on capital controls. I think Glenn also mentioned the issue of parallel markets reemerging in a lot of countries. You know, currency depreciation. You begin to get, for a variety of reasons, I think, and not necessarily the same reasons. I think, you know, there are inflation risks in a number of the more vulnerable, you know, countries that are having also debt problems. Very quickly on the Augusto's point, you know, Augusto, this is an observation that I've been, you know, grappling with for some time. You know, that that the flows from advanced to emerging are debt flows. You know, historically, equity flows. You know, you had a period sometime in the 19th century. And look, I do think that a lot of the debt flows leave out currency risk. You know, so it's, you know, dollar denominated debt for, you know, hard currency denominated debt on the equity dimension. It's not really, you know, the real currency risks. And you look at some recent work that looked at long-term equity returns. When you compare them, you know, when you compare the bonds, the debt investments in EMs to the equity investments, the debt investments come out better, not even taking into account debt restructuring and defaults and the like. So but it's a real challenge. I mean, shifting the balance from debt to equity. Anyway.
So thank you. That's great. So
Can I just add a few
please,
comments?
Glenn, please.
I was going to. It goes back to the first question about the externalities. Even before the COVID crisis, the G20 under the German presidency started an initiative, Compact for Africa. And that I think that was in the spirit of what concern of migration down the line in years to come. That they wanted to help Africa develop technical assistance and so on. So I think that was a good idea. I don't know how much it's worked in practice, to be honest, in terms of that G20 initiative. But also looking at Africa, one area where equity is flowing is into Africa, but that's not from a high-income country. That's from a big developing country called China. So there may be an incentive for China, there should be an incentive for China to help Africa, given the amount of investment it has in China, which is much different to 10 or 20 years ago in terms of the world situation. I think the risk, though, is that will they do that on a bilateral basis rather than a multilateral basis? And how much will China want to be part of this sort of multilateral solution, which is probably what we really need. Thanks.
So I don't know what everybody's timetables are. We're officially out of time, but we had a couple of very big picture. Let's just kind of reconsider the international financial architecture questions that I can't help but put in front of this group, given how big picture this conversation has been. One of them is a question from Sarah Calvo about, sorry, Sarah, I'm paraphrasing here, that shouldn't we be thinking bigger picture here? Look what Bretton Woods did in terms of not just helping the advanced economies, but the emerging market world. Maybe we ought to be back a little bit back more at the drawing board. A closely related question that we got through the Q&A was one about what individual countries in emerging markets ought to be doing to try to do their own, shall we say, set of structural changes to be a bit more robust. If people have time, I think those are great big picture questions. And honestly, if some of the more severe risks we've talked about today come to pass, maybe these ideas don't seem quite so out there and crazy. Thoughts, reactions?
I may take one quickly. I mean, this is not EM world, but you know, the progress on the EU funds has been a big step forward. It is euro area. It's clearly you know, there is already a European Union in place. There is a common currency, but it has been a major shift. The issuance of European debt by the Commission and the redistribution towards the countries most affected. I think coming out of a period where clearly leadership in a variety of advanced economies and the EMs was very much on the populist anti-global front, seeing a consistent effort at the global level on that seems much more far-fetched. I think things have improved, has been noted before by Glenn, but I would defer to the political scientists. I think clearly a global shock is one that warrants global solutions, but how much common ground can you eke out considering the degree of geopolitical tensions? I really don't know. I think where you really had enormous room to for a big multilateral effort was on the vaccine front, because where the ratio cost benefit was so completely lopsided that you could make an enormous difference with a relatively more limited amount of investment. I think it's still the case. But even that effort, which was clearly win-win for everybody, has struggled at times. And there are many things, I think, competing for policymakers' attention, which is also not, a realistic constraint that one needs to take into account. So I hope, at least on the vaccine front, there will be another big push to speed things up. But expecting a large Marshall Plan, I wish, but I don't believe.
Yeah, Guillermo, please.
Yeah, I don't have an answer to the big questions that you raised, but this one question that I want to take advantage of having Augusto here, which is connected to the exchange between Augusto and Carmen about that the flows to emerging markets are taking the form of bonds rather than equity. So the question is that arises, and the reason why maybe, I mean, from what they said, they sort of hinted at, or Carmen hinted at, is the weakness of the monetary anchor. So question is, do you think it's an idea that we should push the emerging markets in this stage where they need a lot of credibility to attract the kinds of funds that Augusto has pointed out before, the savings investment channels, so to say? Wouldn't it be a good idea to sort of have in something like a dollarization or a more reliable exchange rate system?
Guillermo, part of the answer may come by observing what happens in Ecuador, which is an interesting case. This big issue of why foreign savings do not flow to emerging markets, particularly Latin America, in the form of equity, is, I think, a hugely important question. When I look at Latin America, there are very few countries where capital inflows are not associated with spending binges. But instead, capital inflows, particularly FDI, are associated with expected productivity gains. So one would like to see a current account that's associated with capital inflows that is driven by productivity rather than by demand, domestic demand. But I think we have a history, and I have done some work with Alanisio on that. Every time that we have a current account deficit, it's not because there are better prospects of growth, but because we're spending a lot of money. We're going and spending binges. So that creates a very vulnerable current account trajectory. And we would like to see one that looks more like Panama. Panama is the only country in Latin America where you have a very stable current account deficit that is largely financed with FDI. And Panama has been the country that has grown the fastest Asian-style rates of growth in the past 30, 40 years. So does the fact that Panama is dollarized play a role here? Yes, I would say yes, to some extent. One still would need institutional reforms, better legal frameworks, less risk of confiscation, and a better legitimacy for FDI that so that populations see that as compatible with equitable growth. So I would put a lot of focus on domestic reforms, institutional reforms, but I would not completely discard the issue of currency stability. I do think that a lot of the flows that many countries in Latin America experience are of the carry trade type. They come in and they go out and they are just taking advantage of differential returns, but they are not there to stay, or they are not linked to the long-term prospects of the country. So that's a fascinating question, Guillermo, and maybe a good time to raise it again and again.
Almost for certain, I'm sure. Sadly, it seems to be a perennial one way or the other. So we are definitely way over time now. First of all, I want to thank all of the panelists, Carmen, Augusto, Gian, Glenn, for joining us. Thank you to everybody in the audience who could stay with us a little long. This was utterly, completely fantastic. And of course, thank you, Guillermo. Have a great afternoon and a lovely weekend, everyone.